Welcome to This Explainer. I am so pumped to get into this material with you today. If you look at the financial market, it's really like a massive sprawling crime scene. To the untrained eye, total chaos. Just a blur of numbers and flashing red and green lights. But if you're a savvy financial detective, well, it is packed with hidden clues just waiting to be uncovered. So today, we're putting on our detective hats. We're going to learn exactly how to read those clues through the art and science of technical analysis.
Which brings up the ultimate question, doesn't it? Can history actually predict the market? Do those wild, squiggly lines on a stock chart really hold the secrets to future probabilities? Well, the short answer is absolutely yes. And that's because those lines aren't just random data points. They are literally the visual footprints of human psychology. Think about it. Fear, greed, panic, euphoria, they all leave a trace. So, by studying how humans behaved in the past, we can actually build a highly probable roadmap for how they're going to react in the future.
All right, so here is our roadmap for the investigation. First, we'll cover the core philosophy. Second, understanding market trends. Third, decoding chart patterns. Fourth, support and resistance. And finally, key technical indicators. Let's jump right in with Section 1, the core philosophy.
There are 5 core beliefs we need to lock down here, and honestly, the first one is absolutely crucial. Price discounts everything. What does that mean? It means all the known information out there, economic data, political events, earnings reports, the whole shebang, it's already baked into the current market price. We don't really need to read the news, we just need to read the price. On top of that, prices move in established trends, and because human psychology is so cyclical, history repeats itself. Now, obviously, this doesn't mean we have a magic crystal ball, right? Market action is predictable to a degree, which means we are dealing in probabilities, not certainties. And finally, we always look to trading volume to confirm the strength of any price movement.
Okay, let's dive into this contrast for a second. You are going to hear technical analysis debated against fundamental analysis all the time. But listen, they are two entirely different games. Fundamental analysts, they act more like business owners. They're poring over financial statements to find a company's intrinsic, long-term value. We, on the other hand, as technical analysts, act like forensic scientists. We focus purely on price action and volume to capitalize on short to medium-term opportunities. We care about market behavior and those immediate supply and demand dynamics happening right there on the screen.
Moving on to Section 2, Understanding Market Trends.
Now we're looking at the big picture with the 6 tenets of Dow theory. You can think of these as the absolute laws of gravity for market behavior. They basically reiterate that the market discounts everything and that volume must confirm the trend. But they also introduce this really interesting idea that indices must confirm each other. So, if the broader market is healthy, multiple sectors should be rising right alongside it. But the most crucial takeaways here are how Dow actually categorized the lifespan and structure of trends, and the rule that trends persist until a clear, definitive reversal signal is given.
Dow categorized these trends perfectly, kind of like an ocean. The primary trend? That's the tide. It's the dominant bull or bear market that lasts over a year. Within that massive tide, you have secondary trends. Think of these as the waves, the corrections or temporary rallies that last anywhere from weeks to months. And finally, you have tertiary trends, which are just the daily or weekly ripples right on the surface. By understanding that trends exist inside of other trends, it's like a giant puzzle. You can figure out exactly where you are in the overall market cycle.
All right, Section 3, Decoding Chart Patterns. Let's zoom in on the micro level. Our first footprint is a candlestick pattern called the Hanging Man. You're going to spot this after an upward price move. It has this small body and a long lower shadow. And that long shadow, that is your main forensic clue. It tells us that during that specific trading period, sellers aggressively pushed the price down. Even though buyers managed to push it back up by the close, the Hanging Man is a huge early warning signal that the bulls are exhausted and they're losing their grip. Conversely, we have the Hammer. This is the exact opposite footprint. It looks identical in shape, but it appears after a price decline. Here, that long lower shadow tells us a completely different story. It shows us exactly where the smart money stepped in, absorbed all of that selling pressure, and successfully pushed prices back up to stop the bleeding. It's a really powerful sign that a downtrend might finally be ending.
Then we have the engulfing pattern. This happens when a massive candle body completely covers, or basically swallows up, the previous day's candle. And look, whether it's a green bullish engulfing candle or a red bearish one, this pattern screams one thing: dominance. It literally means one side of the market has violently and aggressively overpowered the other, signaling a massive shift in momentum. But hey,
The market isn't always just reversing, right? Sometimes it just needs to catch its breath, and that is exactly where consolidation patterns like triangles, flags, and pennants come in. When you see price action squeezing into these really tight sideways geometric shapes, it means buyers and sellers are briefly at an equilibrium. But make no mistake, the pressure is building. These patterns act like a coiled spring, telling us that a huge, explosive breakout in the direction of the underlying trend is totally imminent.
Next up, Section 4, Support and Resistance.
Now, what's really interesting about this concept is how it perfectly frames human behavior. Support is the floor. It's a price level where a downtrend pauses because there is just a massive concentration of buying demand. Resistance, on the other hand, is the ceiling, where an uptrend stops dead in its tracks due to a heavy concentration of selling supply. And these invisible floors and ceilings, they are entirely created by institutional orders and trap traders who anchor their memories to these very specific price levels.
So how do we actually know if a floor or ceiling is going to hold? Well, we look at the forensic evidence. The strength of any support or resistance level depends on 4 key things. First, the number of touches. The more a level is tested and holds, the stronger it is. Period. Second, high trading volume at that level shows massive conviction from the market. Third, the longer the time spent consolidating near that level, the more significant it becomes. And finally, recency. Recent levels are going to carry way more weight than something established 5 years ago.
Let's move on to Section 5, Key Technical Indicators. All right, let's start with the Relative Strength Index, or RSI. This measures momentum on a scale of 0 to 100. When the RSI hits 70 or above, it signals that the market is overbought. Think of this as a glaring mathematical warning light flashing on your dashboard. It's telling you that the asset has been pushed up way too fast and it might be rapidly running out of buying steam.
Now, contrast that with an RSI of 30. This is the oversold territory. The market has just been beaten down heavily. And this is precisely where observant detectives start looking for bullish divergences. That's a situation where the price might actually make a new low, but the RSI doesn't follow suit. That divergence right there is a beautiful early mathematical buy signal.
Let's see how this all builds together with another tool, the MACD. This looks at converging and diverging moving averages. The core logic here is a step-by-step crossover. Basically, you watch for the fast MACD line to cross right over the slow MACD line. Then, you observe the momentum shift and you wait for both lines to rise. But, and please hear me on this because it's absolutely critical, you never trade the indicator blindly. You must always confirm that fresh momentum with actual upward price action on the chart itself. Indicators show you the momentum, for sure, but price is always the ultimate truth.
Finally, we have exponential moving averages, or EMAs. These are great because they smooth out all that choppy price data to reveal the true underlying trend. A highly effective combination uses the Fibonacci numbers 13, 21, and 34. By stacking these on your chart, you get an instant visual readout of market strength. In a healthy uptrend, the price sits right above the 13 EMA, which sits above the 21, which sits above the 34. They spread out perfectly like a fan, providing this amazing dynamic moving support for the price. It proves that short, medium, and long-term momentum are all perfectly aligned.
So pulling this all together, the crucial point is summarized perfectly by this quote. Technical analysis is a guide, not a guarantee. We've looked at Dow theory, chart patterns, support levels, and mathematical indicators. Together, they create a phenomenal system for managing risk and putting the probabilities completely in your favor. But, as we all know, there are absolutely no certainties in the market.
Which leaves us with this final thought. You now possess the tools to view the market not as some chaotic mess, but as a landscape of human psychology and footprints. The clues are right there on the screen in front of you. So, the next time you open a chart, how will you use these tools to manage your own uncertainty and uncover the market's next move? Dive in, study those charts, and become the detective your portfolio needs. Thanks so much for joining me on this explainer, and I'll catch you next time.